Eu vou falar em inglês para apresentar o Larry. Larry White is a distinguished professor at George Mason University. He specializes in history of banking and monetary theory. He is the most amazing writer, in my opinion. I had contact with his books since I learned about Austrian economics back in 1997 or so. So Larry influenced me very much, and the Austrian School of Economics wouldn't be the same without Larry White. So I welcome Larry. Thank you very much for being with us.
Thank you, Eddie. Good luck. Okay, I want to talk about free banking, Bitcoin, and the gold standard, and normally I would need about a whole semester to cover these topics, but I'm going to try to give you some highlights in half an hour. And I think it's important for Austrian monetary theorists not just to rehash the old theories, but to think about new developments like Bitcoin and cryptocurrencies. So taking a completely pragmatic starting point, why are we interested in private currency systems? Because the state-run currency systems are not reliable. They do not deliver a good product. Chronically, they oversupply money. And when they supply money more than expected, they drive interest rates down. When they drive the interest rate below what we call the natural rate, the rate that would establish intertemporal equilibrium, then there's an investment boom which ends in tears because the real resources are not being saved to actually finance all these projects. So we just went through the Great Recession after the housing bubble burst. It's a classic example now of a credit cycle causing a crash. Occasionally, there are times when there's too little money in the system, and central banks are not very good at fixing that, or recognizing it promptly and fixing it, although it's supposed to be part of their duty. So here was the progress of the economy in the United States, and I've drawn a dashed line through it to show the long-run trend. And you can see the credit bubble building up. The line is above the trend. It's unsustainable, and it comes crashing through. The shaded band is the official recession period. It comes crashing through, and then the recovery starts, but the recovery is taking a long time to get back to the old trend. And I think that's because there was capital destroyed by the housing bubble. A lot of savings went into building housing projects that didn't cover their costs, that nobody wanted to live in, at least not at the original price. A lot of mainstream economists miss this because they don't put a trend through the data this way. They have a concept of potential output, and the actual economy never reaches the potential output, or very seldom. So all they see is a return to full employment. They don't see overinvestment. Now, if the central bank knew where the natural rate was and didn't have an agenda like put everybody in a house or keep interest rates low, if they tried to target the natural rate, that would be great if they could find it, but they don't know where it is. It's an equilibrium concept. It's not something directly observable, and so that's the problem. The central bank doesn't know where the natural rate is any more than a Soviet planner, as Roger Garrison says, would know where the right prices were if you told them, provide the right set of prices to the economy. There is a kind of trial and error where the Fed discovers that the procedure it was using gave rise to a housing bubble, which then crashed. But, you know, that's very long-run, slow learning process. If they adopt some other framework, as they have since the financial crisis, it's going to take some years to find out what the flaws in that system are. So really having central banks use interest rate targeting, I think, has failed the test. It doesn't provide for steady growth in the economy. This has been recognized even by some architects of the mainstream standard macroeconomic theory, which is dynamic stochastic general equilibrium models. So Guillermo Calvo, who's an Argentine economist teaching in the US, wrote this remarkable paper in which he says, you know, we the profession, missed the credit bubble because our models didn't have any room for it. But if you look back at the literature of Mises and Hayek, and he actually distinguishes, finds some differences between Mises and Hayek, and he's right about it, so he's read carefully. Look, Mises gave us some pretty key insights that if you overextend credit, it will end in a tragedy. And he says Mises attributed it to central banks' propensity to try to keep interest rates low to ensure full employment. So they tend to err on the side of interest rates too low. And he adds an important lesson. If there's real malinvestment, then that's a big waste. It's hard to, as he puts it, put Humpty Dumpty back together again. That is, restore the economy to its previous level of prosperity, because resources have been wasted. Okay, so that's why we're interested in this topic. How reliable is money from the market? All right, that's an open question. We need to actually study historical systems and think theoretically about what a market monetary system would look like. I'm going to talk about three alternative versions. The first one is a commodity standard with free banking. And although I say commodity to be general, I really mean a gold standard. I mean, that's the most viable option. And this has a track record. It's got a history. There were lots of free banking episodes that we can study and see how well they performed. It's the system that Adam Smith talks about in The Wealth of Nations. And he recommends a couple of minor restrictions on banks and then says, otherwise, the banking trade should be left completely free, and the more banks, the better for the public, because they compete, they keep the terms of loans and deposits competitive, pay more money to attract deposits, and they'll lend at lower rates if there's competition. And plus, the more banks you have, the less consequential is the failure of any one bank. Right? So Adam Smith was no defender of the Bank of England, which in England had a monopoly. But around him in Scotland was a competitive banking system, which he said has done great wonders for enriching the Scottish economy. Adam Smith's theory, though, was a little shaky. Mises put the theory of free banking on a firm footing, particularly in the theory of money and credit. And I'll come back to that in a minute. Then I'll talk about Hayek's denationalization of money and about cryptocurrencies. So when I say a gold standard, I mean a system in which gold defines the monetary unit, and we technically say it's the medium of account. Some amount of gold, so many grams of gold define the unit of account, but in different countries there are different size monetary units. There are different sizes of gold, different amounts of gold, but all the countries on a gold standard are using gold as the medium of account. And secondly, gold serves as the medium of redemption. So in any technologically advanced banking system, banks will be issuing claims denominated in gold, banknotes and checkable accounts. And if you want to, you have the option to go to the bank and redeem it, get gold coins. So that's what's in the bank's vault. Nothing in this definition presumes that you need a central bank. You can rely on private institutions to carry out the function of redeeming paper money for gold. And I say that because a lot of mainstream economists, when you ask them, what is the gold standard? They say, well, the gold standard means that the central bank follows the such and such policy. Often they don't even get the policy right. I had a Twitter debate recently with an economist who thought that a gold standard meant that the central bank followed an interest rate rule calculated to stabilize the price of gold. And then he looked at the price of gold over the last 20 years when gold is demonetized and said, well, see how volatile the price of gold is, then the central bank's policy would have to be very volatile. And it's just crazy. That's not how the gold standard worked. You had it in countries without central banks, United States, Canada, Switzerland. It can't be that some central bank policy defines how the gold standard works. Plus, if you want to evaluate the gold standard, don't look at the price of gold over the last 20 years. Look at the price of gold under the gold standard before the First World War. So I mentioned redemption. Redemption means banks are issuing claims denominated in gold, and they do that because for many purposes the public finds that a more convenient way of paying people than gold coins. So gold coins are available, but historically they're not the most popular method of payment or medium of exchange, but rather bank-issued money, banknotes and checkable deposits are more convenient. In the early days of banking, some people used the vaults of the bankers just for safekeeping. And in that case, they had a kind of a warehousing arrangement with the banker. When they, in Middle Ages, if you wanted the banker just to store your coins and not touch them, not lend them out, you brought them to the banker in a sealed bag. And it was understood that the banker doesn't open the bag. But there was another arrangement, which was if you bring in loose coins and open the kind of account where you get paid interest, you're lending money to the banker. You don't get the same coins back. You only can get equivalent coins back, but you have that right. But you are lending the money to the banker and participating in the enterprise in the sense that you're getting some of the interest that the banker earns by lending out your coins. And that was understood by the law. So the banker lending out the proceeds of a deposit is not a fraud, and I hope the Murray Rothbard on my pin will forgive me, is not a fraud as long as the customers understand and agree to it. And in my reading of the historical record, they did. And why did they agree to it? Because they don't have to pay storage fees, and they even get interest on their account. So if what you want from your deposit is to participate in the payment system, then that's the kind of account you want. If you don't want to participate in the payment system, if you just want safe storage, then go to a warehouse. When many banks are issuing their own notes, people sometimes worry that there'll be floating exchange rates between banks that are across the street from each other, and wouldn't that be chaos? Well, that would be chaos, and that's why it doesn't happen. It's in the interest of the banks to prevent that from happening. So what you find in free banking systems is the banks make agreements with each other. I'll accept your notes at face value, at 100 cents on the dollar, if you accept my notes at face value, or at par, we say. And whole networks are established of banks that accept one another's notes and deposits. And then they have claims on each other. And they don't hold on to these claims. They don't reissue them. They go to the clearinghouse. They're all members of a clearinghouse where they exchange their claims on each other. And then banks pay each other in gold for the difference between what they've collected of other banks' notes and what the other banks have collected of theirs. So the clearinghouse is where a bank that has overissued, has issued too many notes or expanded too many deposits, will find the claims against it exceed the claims that it's collected, and it will have to pay up. It will lose gold reserves. And losing gold reserves is the signal and the incentive to stop the expansion. They have to reverse it. So the clearinghouse system keeps banks in line with each other. And that's what we see in this. The case I've studied the most is Scotland, but we see it similarly in Canada, Sweden, Switzerland. There's a long list. So let me compare the gold standard to fiat money standards. And two obvious questions to ask is which one has the lower inflation rate? And you won't be surprised that it's the gold standard, not fiat money. From a paper by Rolnick and Weber, which examines this question, the relative performance of commodity and paper money systems, fiat systems, I just took the top two countries on their chart because A and B, turns out to be Argentina and Brazil. So the dark bar represents the average inflation rate in Argentina under the gold and silver standards. The vertical line represents 0. So very tiny inflation, and likewise for Brazil. And then the lower bar, the one with stripes in it, The long bar, that's average inflation rate under fiat money. So really not even close. In some countries, it's a little closer, in Europe and the United States, but it's still a difference between average inflation rate of 3 or 4% under fiat money to an average inflation rate of close to 0 under the gold standard. Second point I want to make, and this is a little less obvious, the gold standard gives you a more predictable purchasing power of money, especially at long horizons, by which I mean 10 years in the future, 20 years, 30 years in the future. And that's important to the bond market. You don't want to buy a 30-year bond denominated in, say, reales, if you don't know what the reale is going to be worth in 30 years. So uncertainty about future purchasing power puts a big premium on long-term debt, and people shy away from it. And that means businesses find it more economical to borrow short and roll over their financing. But that's a dangerous game. That's what sets up the Austrian business cycle, where when the interest rate goes up in the middle of your project, you discover that you can't complete it profitably, and there's a cluster of error, there's a cluster of bankruptcies. If you could lock in your financing for the entire length of the project, you wouldn't have to worry about changes in the interest rate. Right? But there's a big price to pay for that in a country where the purchasing power of the money is unstable. So you don't find thick bond markets in countries with unstable currency. You can't get a 30-year fixed rate mortgage on your house. You have to borrow short and hope to roll it over. And we see in the average maturity of corporate debt shrinking after we left the gold standard because of this uncertainty of future purchasing power. And I'll come back to why the gold standard has this predictability. But just some other items on the checklist. Milton Friedman's biggest argument against the gold standard was that it costs real resources, miners and mining equipment, to dig up gold and then just bury it in the vault of a bank. So why don't we avoid that? Why don't we manage our paper money standard, our fiat standard, so that it produces the same inflation rate as the gold standard without that expense? And so Friedman was in favor of President Nixon shutting the gold window in 1971, that is, no longer redeeming the dollar for $35 an ounce, because he hoped that something better would be substituted for it. Yeah, it didn't happen. I think he may have regretted that. What happened instead was inflation just kept going up, and there was nothing to stop it because the Federal Reserve no longer had a constraint from the requirement to back its dollars with gold. And as a result of the inflation, private citizens around the world have started hoarding, if you want to put it that way, accumulating, hedging in gold against the inflation. And so they've been buying a lot of gold. If you look at the reports of the World Gold Council, they have all the numbers on it. And private citizens now own more gold, more monetary gold, that is coins, bullion, and ETFs. Private citizens own more monetary gold than central banks do. And therefore, the price of gold hasn't gone down. We haven't saved any resources from going off the gold standard. In fact, the price of gold is higher, so there's more mining of gold for monetary purposes. The resource cost has actually gone up under fiat money. Gold standard is a non-political money, so it has the potential of being an international money. And being an international money means that it lowers the cost of transacting across borders. You don't have to worry about devaluation risk. You don't have to stop and change currencies. So that's an advantage. The classical gold standard was the first period of globalization where international trade became much thicker, and in some respects was thicker then than it is now. Lastly, the gold standard provides a kind of fiscal discipline. If a country wants to borrow money, it has to issue gold-denominated bonds, which means it has to come up with the gold, something they can't just run off on a printing press. And that's a constraint. That makes it harder to borrow, which is good. Oh, sorry. Some people defend fiat money by saying Well, look, at least it has reduced unemployment and the business cycle, and we have better macroeconomic policy now. Yeah, that would be nice if it were true, but it's not true. If you actually look at the numbers on the variance of real output and of unemployment, there hasn't been an improvement. It's basically the same. If you count the entire period since the formation of the Fed, it's been much worse because that includes the Great Depression. But if you leave that out and just look at the post-war period, it's still not true. It's basically a wash. Business cycles and unemployment basically the same in the two regimes. So I want to talk about why the purchasing power of gold is reliable. And it's reliable because, well, we can analyze it in terms of supply and demand. And basically the reason is that when there's a change in demand, there will be a matching change in supply, so that it's the quantity in circulation that changes, not the purchasing power per unit. In any one area that's a member of an international gold standard, there could be a local shock to demand or supply of money. That'll be spread out over the entire world so that it won't have much impact locally compared to what it would have if this were the entire economy. So I'm saying the local purchasing power of money is constrained by the world purchasing power of money. But what determines the world purchasing power of gold? Well, supply and demand. The supply coming from gold mines and the demand coming from people who want to use gold as money, or banks that have to hold gold as reserves against their bank-issued money. If you look at the historical numbers, demand for gold grows with the size of the economies, and so we can see a real growth rate of about 3%. The growth in the monetary demand for gold might be a little lower than that because there are some economies of scale and technologies were being developed to economize on the use of physical gold, but about 3% a year. And so it's not an accident that world gold output grew 3% a year. This is what I'm going to emphasize. So that supply grew along with demand, and that kept the purchasing power stable. It's not an accident because here's the mechanism that keeps them in line. If the purchasing power of gold, well, let's say gold fails to grow as rapidly as the output of goods, so we get a benign deflation, but that means a higher purchasing power per unit of gold, and that raises the profitability of gold mining. So the gold mines will dig a little deeper, and prospectors will find new sources, and the output of gold will rise above the long-run trend. That'll help relieve or bring down the purchasing power of gold, and you'll get back to the original purchasing power of gold in 20 to 25 years. It is a long, drawn-out process. But the fact that it works and everybody can rely on it means that people don't overreact in the short run. They know what the long run is going to do to restore the purchasing power of gold. So there's a stabilizing dynamics. And if you'll forgive me, I'll show you some supply and demand curves. Pretty exciting. So here's the stock of monetary gold measured in ounces, plotted against purchasing power. We can draw in supply and demand curves. And what does a supply curve mean at a point in time for the stock of gold? It means there's a lot of non-monetary gold, which is ready to be converted into monetary gold if the price is right. And so people melt down their jewelry when it becomes more valuable. In a sense, they would rather have the things they could buy with the gold than to keep the jewelry. You might think that's a trivial amount, that people don't melt much gold, but actually they do. The World Gold Council says that today, about 1/3 of the flow of gold comes from recycling, which means people selling their jewelry to have it melted down. The other 2/3 comes from from the mines. But suppose there's a shock to demand for gold. So I've got the demand curve shifting upward. That'll raise the purchasing power of gold. Not as much as if the supply curve were vertical. Some of the demand will be satisfied by conversion of non-monetary gold to monetary gold. So the supply curve is not vertical, it's sloping upward. Now, that can't be the end of the story because, as I said a minute ago, when you have a high purchasing power of gold, that's going to affect the mining industry. So we need a second supply and demand diagram. We've got a stock diagram here. We also need a flow diagram, which shows what's going on in the gold mining industry. And the high purchasing power of gold is going to encourage more output of gold. Like I said, the miners dig a little deeper. But it also discourages industrial use of gold because now other metals are cheaper. And so there's a gap opening up. The output of gold is going to exceed the industrial demand. And where can it go? It goes to the mints. Right? If you have excess gold, you can always have it coined and then use it to buy whatever you want. And that coinage is going to start to shift the gold supply curve in the stock market. It's going to start to increase the stock of monetary gold. So that's going to start shifting to the right. And as it shifts to the right, it's going to bring the purchasing power of gold back down. When is it going to stop shifting? Well, given that we need to go back to where the flow, supply, and demand curves cross, the stock supply curve keeps shifting until the purchasing power comes all the way back down, because until then, there's still a gap, which will be expanding the stock of gold. So this is a stationary equilibrium. I mean, I'm assuming that the equilibrium is characterized by no growth in the stock of gold, but it's easy enough to generalize it to having a steady growth in the stock of gold. But anyway, the demand shock was reversed. Or another way to put it is, the effect on the purchasing power of gold is reversed. Another way to put it is to say the increase in demand is satisfied by an increase in supply in the long run and not by any permanent change in the purchasing power of gold. So that's what keeps returning it to its long-run trend. You can have a permanent change if there's a permanent change in the cost of mining gold. And the California discovery in the 19th century, 1849, was the biggest example of that, but it was smaller than you might think. It did raise prices, lower the purchasing power of gold around the world, but by about 1.5% for about a decade. So not all that much by modern standards, and a lot less than people predicted at the time. A lot less than modern monetary systems change the monetary base. What happened? There we go. So here are some numbers comparing that decade, which is an exception. Right, so this column shows average annual percentage rate of change, meaning the growth rate of the stock of monetary gold. And you can see all the figures are around 1%, 2%, between 1% and 4% is the normal range. The California discovery is an unusual event, but the money supply still grew less than it does routinely under fiat money systems. Okay, I wanted to say one more thing about a free banking system, because some changes in demand for money will be satisfied by the banks. If what people want is not more gold per se, but more banknotes or more money in their checking account, that can be satisfied by the banking system and will be satisfied kind of automatically in a competitive free banking system. And there's a passage in Mises' theory of money and credit that's easy to overlook, where he emphasizes this point. It's in the middle of a discussion of the debate between the currency school and the banking school. And Mises always identified with the banking school, but the banking school wanted to impose an artificial rule on how much currency there could be relative to how much gold there was in the Bank of England's vault. And Mises said, look, the currency school had a point when they recognized, the banking school, the supposed soft money people, had a point when they recognized that in a competitive system, banks don't have arbitrary power to issue money. They are constrained by the market. And the way he put it was, a single bank will be able to circulate more fiduciary media only if there is a demand for them. And he says a single bank in a competitive system because that bank is going to suffer adverse clearings at the clearinghouse. Right? So it can't just arbitrarily issue more money. It's constrained. Thus, the banks increase and decrease their circulation pari passu, right, in equal measure, with variations in the demand for money. So without any bank intending it, without the banks consciously doing this, each bank just looking at its reserve position and behaving according to keeping a reserve that's safe enough will respond to changes in the demand for money, and that'll help stabilize the purchasing power of money. Okay, I've got just a couple minutes to talk about the alternatives. Hayek theorized about privately issued money that would promise you not a certain amount of gold, would promise you stable purchasing power in terms of a basket of goods and services. Nobody's actually done this, but that was his vision. There are a couple reasons to question it. One, it's hard to imagine 20 different currencies with floating exchange rates in the same city. That seems to be inconvenient. It seems to be contrary to Karl Menger's vision of how we get money in the first place, which is we converge on a common money because it's better for everyone to have a money that everybody else accepts, right? You look for a currency or a medium of exchange that is widely accepted, and that reinforces its acceptability, and eventually something emerges that's commonly accepted. And then secondly, there's the question of whether the issuers would live up to their promise. Because if you can issue money that's worth something, and it costs you nothing to issue it, because there's no commitment to redemption in the system, it would be very tempting to issue a lot of it, buy what you can, and abscond with the assets. And in the system Hayek imagines, you haven't broken any contract. So there's no legal penalty for doing that. So there's a problem. But what we've got in practice as a private non-commodity money is Bitcoin and its followers. And Bitcoin is fascinating because they don't promise stable purchasing power. What do they promise? They promise so many units will be created. On every date, you know how many units will be created and how many exist in total. It's in the program. And the program cannot be altered except by a consensus of all the miners, which is very hard to arrange and would be bad for business anyway. So you can look at the chart and see the growth rate slowing down. That's the one that slows, and the total number in circulation is going to max out at 21 million units. And that's how they reassure you that there's not going to be a hyperinflation, there's not going to be a broken promise about purchasing power. Because the purchasing power is now just completely free, it's only the quantity that's determined. So changes in demand will make the purchasing power of Bitcoin change, and as we've seen, quite erratically. So Bitcoin is going to have trouble becoming a widely accepted medium of exchange for at least 3 reasons. One, they have an incumbent to unseat, so they have to be better than the incumbent. And you know, it's not a good idea. I mean, I encourage you to keep 5% of your investment portfolio in Bitcoin, but I don't advise you to keep your rent money in Bitcoin. Right? It could drop 15% the day your rent is due, and then you're in trouble. And so the volatility is a big problem. And then we found out in 2017 that the payment system gets congested at high volumes. It's not going to match what Visa and MasterCard do. But that's a technological problem, and maybe the Lightning Network, which we heard about yesterday, will help solve that problem. But I don't see it solving the first 2 problems. I actually think private gold has a better chance of catching on. It's already more widely held. I looked up Bitcoin's price this morning, and that number should be now 120 billion. There's 120 billion in Bitcoin that people hold, but there's 1.7 trillion in monetary gold that people already hold in the form of coins, bullion, and ETFs. Now, it's a little hard to spend, but there are projects underway to make it easy to spend online by what's called tokenizing gold. So I got some evidence on volatility, but let me skip to the end since my time is up. What's our job as monetary economists? Too many monetary economists think their job is to reflect on what an excellent or perfect monetary system would look like and then try to create it. So they take for granted that it's the government's job to provide money, and so then the question is one of designing the optimal system. And even a good classical liberal like James Buchanan, for some reason, thought that money had to be part of the political constitution rather than just left to the market. Right? So I disagree with that. Money balances are a private good. There's no market failure. A monetary standard is a kind of network good in that there are these advantages of using the same money as other people, but the market has to choose which is the best network, which is the best standard. We see this in technology all the time. There are competing standards, but the market has to choose which one really serves the needs of consumers. So what we want is open and unprivileged competition, and that means repealing tax laws that disadvantage the use of gold or Bitcoin, like treating, taxing capital gains denominated in gold and Bitcoin. That's a problem. And regulations that suppress the use of cryptocurrencies and of gold-denominated accounts as alternatives to the mainstream, heavily regulated banking system. So that's the mission, and then let 100 currencies compete. So thank you. I'll take questions.
Pretty good, Anna. Yeah. You can
Right. Okay.
Thank you so much. So we'll be taking some questions now. You can WhatsApp them by the number that appears just under the screen. Yeah. So the first question is, you must be thrilled. This is my question, actually. I'm going to use that privilege. You must be thrilled with what everyone is calling modern monetary theory and how popular that it's becoming inside in the Democratic Party. So how do you see that from Science University? And you see this, let's say, it's pretty much a populistic view of the monetary policy, right?
When you said you must be thrilled, I thought you were going to say, buy all the competition among private currencies that's now erupted. So your research has a threat of actually becoming relevant. But modern monetary theory is not sort of serious academic stuff, as you said. It's for popular consumption, and it's spread through Twitter and blogs, not through economics journals, where people's propositions pass the scrutiny of their peers. But substantively, it's just, well, it's hard to pin down. If you accuse modern monetary theory of what looks like an absurdity, then there's a lot of backpedaling, and we never said that. But the way I see it, the message is, we can have lots of nice stuff for free by having the government pay for it by printing money. And the fallacy is, the stuff isn't produced by printing money. To produce stuff, to produce nice things, you need labor and capital and raw materials, and putting more zeros on your currency doesn't produce that, so it doesn't make you wealthier. So that's why it's not very good advice to the government to say you can print all the money you want to pay for things.
So this question actually assumes a preposition. So I'm going to read the question and then you can answer it. How would a decentralized money system avoid fractional reserve banking? But my follow-up question would be: would a free banking system want to avoid that?
Well, that's what I was going to say. I don't think you want to avoid fractional reserve banking, insofar as people want to have it, insofar as people agree to have fractional reserve accounts, and I tried to enumerate the advantages of them to the consumers, then I'm perfectly fine with them having it. I don't see any fraud, I don't see any legal absurdity in a person being a lender to a bank and having the right to redeem on demand. So the bank hasn't breached its contract just by having a fractional reserve. That's not part of the contract. A bank can breach its contract if you show up to redeem and they say, sorry, we don't have any. Then you put the bank under. Then you sue the bank. But banks have gone, reputable banks have gone decades, even centuries, without ever breaching that contract.
There was not one of your criticisms, but a very popular one about Bitcoin is that it lacks intrinsic value. What's your take on it?
It does lack intrinsic value in the same way that fiat money lacks intrinsic value. There are no fundamentals. It's all based on demand for something that is kind of artificially scarce. But that's not a criticism per se. I think you need to look at how the supply is being limited and how reliable that system is, and ask how volatile the demand is and what will be the response to changes in demand. So the fact that it's not backed by something is a reason that it has to be, in a sense, backed. I mean, that's the wrong word, though. It's supported by the rigid supply schedule. That's what gives people faith in it. But that's also a limitation in that it means changes in demand are met entirely by swings in the price. So you see a lot of volatility in the price.
Between policies to return to the gold standard and, for instance, a catastrophic crisis that makes everyone runs for it, which one of those two you see as the most likely to occur if we ever going back to the gold standard?
Well, in a sense, we could go back to the gold standard without any official decision to do so, and then we would just value gold per ounce or per gram, and there wouldn't be any need to sort of establish a new official price of gold. That's unlikely to happen, I'm afraid, until inflation gets really bad. So in a sense, I don't wish for that to happen, but it's good to have that available in case of an emergency, just like it's good for countries with hyperinflation to be able to dollarize. But high inflation countries have shown a tendency to dollarize rather than put themselves on the gold standard for now, because the dollar is the dominant world currency. If the dollar cracks up in high inflation, then we got a private gold standard waiting in the wings. For a government to go back on the gold standard, there is a kind of re-entry problem. They have to pick a ratio between the existing fiat money and the new gold currency. And my recommendation there is pick the current market price of gold so that it doesn't imply that you have to jump the price level upward or downward. That's a problem with attempts to figure out the price by, say, dividing M1 by the stock of gold or something like that.
If the Federal Reserve decides to go back to the gold standard or to begin some sort of policy to do that, which do you see will be the main sectors to object it?
I would think the sectors who think that the Federal Reserve is doing them a favor through its interest rate policies. So I think the housing sector. I mean, I think they're wrong. I don't think it's good for the housing sector that the Fed is creating housing booms and busts. But they seem to think that they can get a favorable policy out of the Fed. Other than that, as I said, it tightens the budget constraint on the government. So people who live on the dole, who live on transfers, who live on corporate welfare, they might be opposed to tightening the budget constraint in that way.
Talking about free banking, how to deal with the argument that narco or terrorism money would behave in free banking environment is like, wouldn't people say that a strong regulation will be needed in place?
You mean regulation on the banks?
On the free banking system in order to avoid narco money?
Most of the regulations on banks early in modern history, so like before 1900, let's say, were designed to give monopoly privileges to banks. So I don't know why anybody would defend those. In the last century, we've had different kinds of privileges. Deposit insurance is the most important. Right? Ultimately, taxpayers are backstopping deposit insurance. So that's a burden on the public. I mean, regulations that are just amount to clear disclosure of the terms of deposits and the terms of loans, I don't have any objection to that. I mean, people should know what contract they're signing. But beyond that, in free banking systems, got together at the clearinghouse, as I mentioned, and the clearinghouses discovered that they needed to put some standards on who they allowed in as a member, and that became a very important disciplinary device. If a bank had inadequate capital, the clearinghouse would tell them, you need to raise your capital. And if they agreed to it, then the clearinghouse would have a press conference and say, we examined this bank and found it undercapitalized, but the owners have agreed to bring it up to snuff, and we stand behind it in the meantime. If not, they kick the bank out of the clearinghouse. Now, if you read the news that your bank has been kicked out of the clearinghouse, and you know the clearinghouse is a group of people who have an incentive to get it right, and they're measuring whether the bank has adequate capital, it's time to run the bank. So that was a very strong, I mean, banks had to comply with that or they would go under.
Unfortunately, our time is over. Thank you so much, Professor.